an investor doing things on your own? How about someone working with a firm that isn't so responsive or in sync with your investment philosophy? My podcast talks you through all things financial. Look, there's stuff you don't deal with very often, but investments, insurance, and retirement is something we plan for each and every day. This is the Pennywise Financial Podcast, and welcome to the show. All right. Welcome to the Pennywise Financial Podcast. Constantine here at Monarch Wealth Management with my co-host, David Georgiev. Welcome to the show, everybody.
Welcome.
Okay. So here we go.
Getting juicy.
I'm trying to lift this leg up. I got another leg injury. I don't know.
This guy is falling apart, ladies and gentlemen. 46? Oh, you're 46 now. That's why. Us young 45-year-olds are spry.
Let's not push it.
Let's dive right into it, Cons. Get in there.
What are we talking about today? How about the cost of panic, right? I mean, who's panicking right now? We've got not one but two wars going on, right? Seems like we're bombing more and more every day. I'm not sure what Trump is going to tweet about when it comes to who did what. What do they say? The latest was last night with the bombing of some place. What was it? I was going to say Bengal. What am I thinking? Bengal Tire?
No, you're talking about the oil reserves.
Yes.
Yeah. And I wasn't laughing at the bombing. Nothing about that is funny.
You were laughing at me. I know that.
Well, yeah, and just Trump and the way he is. It's like watching a movie, literally.
Truly is. You just don't know what's going to come out of his mouth or online. Anyway, cost of panic. So let's talk about that. Obviously, we got to acknowledge global tensions. You know, there's rising costs, inflation. Still, I think some headwinds that we have, the market as a whole, right? But earnings have been looking pretty good. What do you think?
We should sell everything, and then we should go back when everything's okay, right? That's what you're going to tell me?
Yeah, I think that makes the most sense. Right?
Nope.
We get a few of those questions every now and again.
We get a ton of those questions, and we get a ton of when the market, we've talked about this before, when the market tanks, you're going to call me, right, Dave? No, I'm not going to call you. We've done everything to the best of our ability ahead of time, looking into these conflicts that may arise. And Iran was kind of, I don't want to say out of nowhere, but it was to the level of escalation was pretty rapid. But ultimately, what we're going to talk about is how making decisions based on emotion. And that's really when you peel back the onion. There's a war going on. The market's pulled back. What do? We need to make moves. Those are often the best times to not make moves because you'll make an emotional decision which will cost you long-term in your portfolio return.
Well, I do have some people saying, geez, should I be raising cash? So let's talk about cash for just a minute. I think I got a slide here. I don't know. Let me see if I can pull it up here. What am I looking at? Is it this one here? The cost of panic, market timing. So you get this question a lot, I think. You know, it's whether it's be some online, if it's email, if it's phone calls. Hey, market is down. There's a lot of turmoil, a lot of unrest. Should I just go to cash right now? So think about that. Like selling all your, even if it's some, even if it's half. Have you seen anybody do this correctly? Ever?
One guy.
Be honest.
One guy.
Oh, I already know.
One guy, COVID, called me. I have a bad feeling about what's coming up. Let's go 100% to cash against my recommendation. I put plenty of notes in his account that I was not on par with this recommendation. We went to cash. He missed out on the market tanking temporarily. But then because of that same fear, when everything was down in the pits, he never bought back in. And so then eventually things got better, and he was still on the sideline. And things got better and to the point where, well, now it's higher than the initial value was when we sold. So let me wait for another pullback. Long story short, 2.5 years after COVID came and went, and he was still sitting on the sideline.
So this was COVID years.
Correct.
Wow. Think about how quick the recovery was. I had clients that didn't even know that they lost money because it happened intra-quarter.
Yeah.
So quarterly statements come out, and they're like, geez, I'm okay.
Yeah.
Because it recovered that quickly.
And don't get me wrong, you could, I mean, for our tech-savvy people, which is the majority of our clients, you could pull it up every day and see if you wanted to. But the people that just rely on their quarterly statements, yeah, it was like a blip. It didn't even exist almost.
I mean, those tend to be the retired folks that know, that have been with us a long, long time, and they're taking money out, and they know that they're positioned and diversified. But I think this graphic here is just talking about the cost of trying to time the market and get it right. And I have not seen it done correctly. I've seen it against my will, against my discretion, against my direction to the client, that they want to go to cash. And it usually we persuade them either to do a partial or maybe come back into the market. But there are some that will say, look, no, I'm not comfortable with this. At the end of the day, it's the client's money. But if you stayed invested, and we're looking at the last 20 years, and we're just looking at S&P 500, I think it's a pretty basic one.
Yeah.
9.8. So just about 10% annualized return if you stay invested. That means that you have to have the capacity, the ability to stand with it, with the investments, even though the market's down, even though you're down 15, 20, 30+%, sticking with the program. But if you don't, and you decide that you want to go to cash or maybe sell or trim or take profits and then get back in when the market is right, whatever that means, cheaper, lower PEs, or trying to time the bottom, you've cut that return in half. And I would say, I mean, I don't know that this is
10 days. Look
10
at
days,
that.
just the 10 best days.
In 20 years, being out of the market on the 10 most optimal days cuts your rate of return almost in half. 10 days. That's wild. I would never believe that, truthfully, if the data wasn't there. But it goes to show you how acting emotionally. And I have had some clients, some younger clients, I call them my millennials, although I'm sure they're even labeled in a different generation today than millennials, but who sometimes want to buy stocks and sell stocks, and, oh, what do we do with that? Just to be clear, that's not investing, that's trading. And if you're a trader, that's not what we do. We're not traders. We're not bopping in and out of stocks, depending on the day of the week. And I think that's a whole separate conversation for somebody that wants to get in and buy Johnson & Johnson, today because I've been tracking it, and then 2 weeks later after earning, or whatever the case is. Like, that's like a whole separate story where we're looking for long-term success in these companies. So when we purchase something, we believe they'll be profitable for the next 3, 5, 10 years. We may not hold them that long, but we're looking for companies that have long-term sustainability and hopefully long-term track records.
Yeah, I think that's a valid point. Is the entry today? Is it tomorrow? Is it next week? Well, if you have conviction in the stock, whether you buy it today or next week is not really going to have a dramatic impact if we fast forward 5-10 years.
Correct.
Oh, I bought it 5% higher than I should have. Well, you can do some dollar cost average. There's a lot of different ways you can do it, but I think at the end of the day, it's not going to make a dramatic impact on your overall returns.
Correct.
But going to cash and missing just 10 days,
yeah,
that'll cut your return in half. I think that was the main point that I was trying to make there.
Mm-hmm.
And the cost of panic. Let's see, what other stats do we have on here? Dialogue. Here we go. How about let's shift gears a little bit, and we talked about what people are kind of thinking, but maybe it's the why now. It's the war. It's geopolitical issues. Let's talk about that. Do you have any clients that are worried about the war right now and the impact it'll have on their investments?
Yeah, I think specifically with oil. Are we talking about oil yet?
Yeah, we can get. I mean, they do kind of go hand in hand. Yeah.
Yeah, I mean, a lot of trouble on the horizon with oil, where the price of oil has spiked up. I mean, it got up to like $110 or $115 a barrel for intraday and fell back down. It's been hovering in the mid to low 90s. I'm not terribly worried about oil today, as long as this war does end in the next couple months.
That's a valid point. I'm not worried unless it carries on.
Correct. I mean, I remember, I want to say it was 2015, 2016, maybe it was 2014. Price of oil was like $1.25, and that drags down. If we have extended higher prices, and honestly, Constantine, I'm not even worried about the price of oil at $90 a barrel, but $110, $115, $120, $125 a barrel for an extended period of time, yeah, you'll see that crush everything. It'll still have negative ramifications even if it stays at $90 a barrel compared to where it was pre-war, but not nearly damaging to the level it would have at higher, more elevated values.
Well, yeah, because it affects everything, right?
Yeah, it's a tax that you don't realize is a tax. You're paying more for the same, for everything that you're doing. You're paying more. Specifically worried about airlines too. We were talking a little offline about this and the impact it has because of the fact that these airlines have priced you. So you bought an airline ticket 3 months ago for your vacation next month at those old price values. And most of these airline companies don't take into account the variability of the price of oil, for fuel.
They don't.
So some of these smaller airlines, and not even smaller, I mean, you're looking like American Airlines, they're saying it's going to struggle. Some of the big birds, like the Deltas, should be A-okay. And I heard I think it was Southwest, they have that factored into their pricing strategy, which is smart. I mean, smart.
Well, I have to imagine that they would probably have options on oil at some point, maybe increase those, lower those. I do have a chart here. Surprise, surprise. I like graphics. I looking at pictures. I'm a picture guy. I'd say more of a picture guy. But anyway, looking back over the years, so this is historical market resilience, talking about the drawdowns, recovery in the market as a reaction to the connection on oil and the prices. So Pearl Harbor. Pearl Harbor.
English,
5%. Can we get the words out, please? 47 days to recovery. How about the Cuban Missile Crisis? 7% drawdown, just 18 days to recovery. Cuban Missile Iraq, 11% drawdown, 52 days. So that was more of an extension. And then Ukraine conflict. I mean, that's been going on. We don't hear any more about the Ukraine war, do we?
We were just talking about that the other day.
We don't.
No. Why? Why do you think?
I don't know if it fits the bill for the dialogue that wants to be out there right now. The narrative.
I hate
right?
that.
Yeah, I know, because that's thrown around so much, but it's true. So, again, I think that the market is pretty resilient. When we talked about missing the 10 best days, we talked about the impact of oil and prices. Now, I think that the duration of this will have greater impact than the actual headline news that you see on the news.
So when we were at a conference last week, was it last week? Yeah.
Yeah, it was last week.
Future Proof down in beautiful Miami, Florida, and South Beach, which was so wonderful, honestly. Like,
such a treat.
Such a treat. Just like the buildings, the atmosphere, obviously the weather. But we went to a dinner with some key constituents, some people from MSNBC and other places, and some of the people there, some of the key speakers, said that they thought this war would be over in 4 weeks. I don't see that happening that quick.
I don't know about 4 weeks. I think that's a bit ambitious, don't you think?
I absolutely agree.
And what's the goal? What's the end goal on this war, this conflict? Is it Strait of Hormuz and alleviating that? I mean, that was a reactive.
Yeah, I think it's regime change. I think that's the ultimate goal, and I think that's what they're trying to do in Iran, as well as now the Israelis with is it Lebanon, where they have not the Houthis, but the other terrorists.
Is that an English word, Houthi?
Yeah, Houthi.
I don't know Houthi.
Yeah.
What is Houthi?
I think it's a sect of like the terrorist organization.
Oh, geez. Okay.
I might be incorrect.
Bad people. Yeah. Evil people.
Yeah, but I can't think of the Hamas. Hamas?
Oh, okay, yeah. Hamas.
So like the problem, and again, I am no geopolitical expert, but the problem with all of these sects out there is that they all get funded through Iran, and Iran is funding these terrorist organizations in these different countries that then have not political influence, but like terrorist influence over these other countries in the Middle East, and specifically with Israel. And I think Trump's just like, let's just eliminate, like a cancer, let's just eliminate all of this. And we're going to the core of getting them out of Iran, where all the funding comes from, to fund all of these problematic areas and people around the Middle East. Again, I'm not a geopolitical
It's a-
expert by any means.
It's a shame. I mean, I don't think anybody loves war. I think it was a necessity, and I know a lot of people are upset because they want to know the explanation. And I feel like this president is not somebody who's going to outline in detail
Yep.
all of his game plan. He's not going to. He's just not. That's not what anybody that voted for him voted for. I don't believe they voted for the results.
Yeah.
And that's the way he does things. He's very tactical about it. He's very private about it.
Yeah.
He will get the results and report feedback later.
Well, even Pete Hegseth said that. He goes, I'm not going to sit here and tell you in detail what our plans are.
Why would we?
Why would I do that when the enemy is also listening in? Like, that's stupid. And it always killed me when they did this in like previous administrations, Democrats and Republicans, by the way. I'm not just saying one side, where they'd say, we're going to do this. And they have a graph on TV. Do you remember back, I think it was the Gulf War, Geraldo? Do you remember? Got him in a lot of trouble.
Wait, what happened with
Geraldo was like live on the scene back in the day. He was in Iraq. And he's literally in the sand showing. He's like, we're here.
Oh, yes.
The enemies
Yes,
are
yes,
there.
yes, yes, yes.
And it's like, you idiot. You're on live TV. What do you think everybody in the world is watching?
It's crazy.
But even administrations, we do this all the time. And again, whether you like Trump or hate Trump, I don't really care. I think that is wise. We're not going to tell the general public what we're doing when we're doing it, because that also gets broadcast to our enemies as well.
Yeah, why are we going to show our cards?
Yeah.
We don't need that.
Ace is wild.
All is fair in love and war, right?
I guess so.
Yeah, why not? Okay, moving on. The Fed and the new yield reality.
Yeah.
How about a couple of years ago? I mean, I had some clients that had cash at banks, and they were looking for alternative ways to make a little bit more interest, and we had the ability to go out there and shop and buy some individual, whether it be CDs, fixed income, you name it, and grab 5.25. Then it went down to 4.75 and 4.5, 4.25. All of a sudden, wait a minute.
Mm-hmm.
Now money markets in the threes. And I think we're in this new yield reality. And like you mentioned, we were down in Miami, and one of the talks over dinner was the new regime as far as the Fed chair and what will happen with interest rates. And the talk was that rates, we're going to have these 2 or 3 cuts throughout 2026, going down essentially about 1%.
Yeah.
I don't know that I believe that.
I don't believe that.
And I'm not sure, even from 1 week ago, how much that has changed. It may have changed quite a bit because of this new PPI number. And, I guess we don't think about, too, the impact. We just talked about oil. The impact on oil that it has on inflation. It may actually slow things down a little bit. I don't know if people thought about that.
Yeah.
Think about things that restrict people's spending. Well, if it costs more to go out and travel, and even the food that you buy, it costs more to ship it in, and you might be cutting your costs on different things that you would normally spend money on, right?
Absolutely. Again, it's another tax that you don't see coming and you don't view as a tax, but that's exactly the case. So how is inflation going to go down when, which ultimately that's the goal, is we'll drop interest rates once we see inflation going down. If inflation is staying right where it is, they were talking about the Feds when the new Fed chairman comes in, he's going to drop it 50 basis points on day one. I don't think so at all.
I don't either.
Honestly.
I'm not in that camp.
Yeah.
I might be wrong, but I'm not.
But even if take away the oil situation, they don't want I think everybody agrees that the Federal Reserve should not be directly correlated to the executive branch, to the president. So whatever the president says, he just follows suit. He should be separate, completely separate.
That's the whole reason for the division.
Correct. And I don't think that visually it would be good for the American people and for just the world to see if this guy who Trump picked comes in on day one and he's like, 50 basis point drop. Like, it's just a signal that he's going to be a yes man for Donald Trump. And I don't think that they would be so foolish. Again, all the oil stuff aside and the inflationary numbers aside, I just don't think they would be that foolish to do that.
Agreed.
Even though some people would say, yeah, they're idiots because they're, because it's Trump's regime. They're all idiots. I disagree. I heard the saying, take Trump seriously, but don't take Trump literally. And you go back to all the talks.
I haven't heard that one.
Yeah,
I like
it makes a lot of sense when you think
does.
about it. You look at all the conversation with Greenland when he first came in, and even just a couple months ago, like, no, he's not going to take over Greenland by force. But like, it's such an ostentatious. Is that a word?
Yeah, it is.
Okay. Raised by immigrants.
There we go.
Ostentatious demand that everyone's like, oh, this guy's crazy. But at the end of the day, he wants something substantially less than that. But you make it so extreme that by the time you get to what you really want, they're like, oh, all you wanted was some rare earth rights? Okay. It's not as crazy. Where if you went for that, then the compromise would be something less than that.
You got to go down.
Yeah.
Absolutely.
So let's go for the grand slam. And then if I get a base hit, if I get the first, hey, I won. I did exactly what I was trying to accomplish.
He is a negotiator. That is for sure.
Yeah.
All right. How about this?
Commercial?
No.
Oh.
No commercial here. The Fed's new yield reality. Okay. So inflation risk, the hidden tax on cash.
Another chart.
Another chart. I like graphics. Pictures are great. Cash. Listen to this. Cash loses purchasing power 100% of the time. Accurate?
Yeah, of course.
Absolutely.
Yeah.
You put $1 in your safe, I guarantee you 20 years down the road, it's not going to buy you. I can remember my grandmother telling me stories. She was born in 1926 when they would go to the candy shop with a nickel and the stuff she could buy.
With a nickel.
With a nickel.
Yeah.
With a nickel. Now, candy and all that stuff back then was like a treat. Kids nowadays, they take it for granted.
Oh, dude.
I mean, Halloween, I think we throw out half the candy. They don't even want it.
Yeah.
But anyhow, yeah. Thinking about the Fed's new reality and what's going on as far as rates, we're kind of back in this environment where it doesn't pay a lot to put money in a cash savings, CDs. It's just not paying.
Yeah.
So you've got this cash trap of people that are looking for other ways to find income. You're not going to find it in CDs. You're not going to find it necessarily in fixed income with rates being so low.
But if you do, let me ask you this, Conch, just to play on the other side of the fence.
Oh, let's hear it.
If you're worried about if you have money on the sideline, I'm not talking pulling out or making drastic decisions in your portfolio. Your portfolio's long-term, it's invested, no worries. But now I have money on the sideline. I just sold my business. I just got an inheritance, whatever the case may be. During these war times, during these just crazy geopolitical environment, is cash for the short term, 6, 12, 18 months, can I get a yield? Is it worthwhile if I'm uneasy of where to go?
Yeah, I think that's $1 million question, right? And we talked about it earlier in the show, is do I go to cash? And I think if it's really long-term money, I think the answer is no. If you're 45 and you say I have 20 years till I retire and I don't anticipate taking any money out prior to that, I think the answer is no.
So let's say in that scenario, I have a $250,000 in cash, got it from Gam Gam. She passed away.
Oh.
Right? I know. Gam Gam. She was old. She was 105, whatever the case is. So now, and I don't need this money for the next 20 years. Okay? Am I just taking that $250,000 and putting it right into the market? What's some advice on that?
Yeah, really good question. I think it's taking a look at your appetite for risk, right? I've seen it play out many, many times with different clients. Again, we give the best advice we can. At the end of the day, the clients are in the driver's seat, right? We're the navigation, if you will. And there's going to be detours and construction and there's going to be road closures. But I think our goal is we want to get to that target of where we're driving to. And how we get there might look a little different from client A to client B. And if your appetite for risk is not there and you're not going to be able to stomach that, there are things we can put in place to do that. I think long-term, you're going to be just fine. I really believe that. I have conviction in the market. Betting against the U.S. and the economy and the S&P 500 has not worked out very well for you if you've done that in the last 5, 10 years, even 20 years. As time goes on, the reversion to the mean gets closer and closer, and I think that if you're patient, you will be rewarded. I think of it when we were kids and we work in a restaurant. You have the cooks in the back of the house and dishwashers. They get paid regardless if it's busy or not. If you're a server out in the front or a bartender, you have no idea. If it's dead, and again, I'm going back to when we were 16, 18 years old. If the restaurant is dead, you're not making any money. But I'd say there's more times than not that you're going to make out and fare much better by being patient, resilient, and being able to stomach that. There's a reason that people that are wealthy and have accumulated assets stay that way. They understand it. They comprehend. They're able to buy more shares when the market is dipping. And the folks that need the advice most, in my opinion, are the same people that keep their money in the CDs and savings and are scared as hell to put any money to work.
Yeah.
I got a little excited about that.
A little bit.
Yeah.
It's funny, as you're talking, I got a message from one of our higher net worth clients that literally said, Dave, give me a call later. Maybe we should buy on the dip. So literally, like, it's proof that a lot of people that have wealth, they've seen long term what happens, and they don't panic as much. They look at it as an opportunity. And I think that 6 months, a year down the road, and maybe today's not the lowest day of the market. Maybe that's still to come. Maybe that's already happened. That's what you will see, is there was immense opportunity, but fear kept me out of making the appropriate decision.
Yeah, I actually had, I think I told you before we started the show that I got a message about somebody looking to fund their Roth account. Is now the time? Hey, the market's cheap. Should I be putting that money to work? Well, maybe, yeah. Well, I mean, think of the grand scheme of things. It's not going to have a major impact, but why not buy on the dip? My son snowboards. I ski. Well, usually, unless I'm injured like this year. But when you're going down that mountain, you're traveling at high speeds. The end goal is to get down to the base and not fall and not hurt yourself. But if you look down at your feet right in front of you, or even a foot or two ahead of you, you're going to be in rough shape. Yeah. You're not seeing what's down the horizon, what's down the road, what's down that slope. And that's where you should be focused on, is downward. Things happen so fast in this market. The information travels so fast. I think that the market cycles are shorter, more nimble, they're quicker. The path to the market heading south and then recovering and rebounding is so quick. Yeah. It's getting shorter and shorter.
It's a lot more volatile, like quicker.
And we could have a whole podcast just on that. I think some of it has to do with algorithms and AI and how quick you have a program that's systematic in the way it trades. If S&P is down 10%, sell everything, and then buy back in when it trickles up 1 or 2%. When you have those mandates in place where the market just automatically or blindly takes action, I think that has consequences for everybody else.
Absolutely. Absolutely. And if you do, like going back to, Gam's inheritance, if you are worried, but you know that long-term things will be better and you don't need the money, dollar cost average,
Absolutely.
Hey, over the next 6 months, over the next 8 months, we will get this money fully invested for you. But I understand why you don't want to do it now because of all the chaos, and we don't know what's going to happen tomorrow. But we believe over the long haul, things will revert back to their mean, as you mentioned earlier, and I would agree with that completely. Everything does historically come back to its mean.
It does. How about non-correlated assets? Mm-hmm. We talked about ways for looking for income, right? Mm-hmm. And surprise, surprise, I do have a graphic.
Oh, another picture.
Looking at non-correlated assets. So what the heck are we talking about? Private credit. That hasn't been in the headlines lately, has it? Private credit. Okay. We talked about private real estate, structured income, gold. Has gold been in the news lately? I mean, last year gold was one of the top performers. So were stocks. Alternative energy sources, commodities, things like gold, copper, silver. So I think there are ways for folks who are more aligned to maybe looking at more stability and income and having the capacity to zig when the markets are zagging, the stock market, S&P 500. If you have all your money there over time, yes, it will rebound, it will recover. But if you need to draw 5-10% of your portfolio out to supplement your income, can you sustain a 30% loss? And for how long?
Yeah.
Remember back in 2008, remember 2001, September 11th? There were a ton of wholesalers for annuity products and insurance-based products that would talk about the sequence of returns and how important it is. So when you retire, depending on what the market conditions are given, if you're not diversified outside of the S&P 500, and I don't mean just stocks and bonds, because stocks and bonds doesn't always work. And we've seen that happen just a few years ago where both stocks and bonds were both down. You could not hide.
Yeah.
So I guess that year, if you were in some cash, you might have won out.
Yeah.
Right? But I think having some other things in place that are not traditional, non-correlated, I have clients that use this. It's not for everybody. It's different. There are more strings attached. I think there's some qualifications. You have to meet certain requirements. There's liquidity issues. So there's a trade-off, right? These are not stocks or not bonds. They're outside an asset class that may have some stability in income, not guaranteed income, but stability in income. And it's an asset class that will not behave exactly like a stock.
Yeah.
I think that adds a lot of value.
Well, I think we're also in the market where the days of just buying the QQQ and the Vanguard S&P 500, I don't think they'll perform as well as active money management will right now. And what you'll see when you have an institution or a wealth management firm that can add that breadth to your portfolio, that can add, I don't want to say diversification, although it is, but that's such a lame generic terminology. Adding real assets, adding BDCs, adding gold, utilities, commodities, all of these different asset classes and sectors that can really increase your alpha in your portfolio. I think that's the competitive advantage where your passive tech market, your passive, again, S&P or indexed ETF will take into account everything, which is not always profitable. In a market where everything's going up, yeah, throw anything against the wall, it'll do okay. But in this type of sideways market, which I think we'll see, I don't think everything's going to tank, and I don't think everything's going to go to the moon. I think you're going to have a lot of things that are going to be sideways for the near future. So finding areas of opportunity, specifically in different sectors, will be the competitive advantage.
I think so, too. I think it's kind of to me, it's almost more scary to be in the middle, not knowing, trading sideways, than a market where we see bullish commentary, where earnings are growing, or a market where it's declining. You kind of know what to expect. The sideways trading is somewhat scary for people.
Absolutely.
Non-correlated assets. So when we talked about these different areas to invest in, I guess it's a little bit more complicated than just a visual, a chart to say, does this make sense? However, a 70-10-20 portfolio is more of a modern approach. I do agree with this. I don't think this is the end-all, be-all, if you will. It's not a recipe that everybody should have in their kitchen. 60-40 used to be, hey, 60% in bonds or in stocks, 40% in bonds. I'll be okay. My bonds will help to offset the blows from stocks when they're coming down. I don't think that's the case anymore. We've seen that happen time and time again.
No. 2022, I mean, literally, the stock market in 2022 market was down. S&P was down like 20%. Your bond portfolio was down like 12%.
Crazy, huh?
Yeah.
You're safe. You're buffer.
I don't love the 60-40, and I haven't for quite some time. I don't really love bonds as that big exposure. Now, don't get me wrong. If you're conservative, like that's a whole different conversation. I'm talking for your average investor that can stomach some stock and fluctuation in their portfolio.
I think that's the other thing to consider, too, is when we're looking at adding these type of non-correlated assets, right? 5, 10, 20% weighting, let's say, is going to increase your Sharpe ratio. So what's Sharpe ratio? Risk-adjusted return. Not only adding alpha, meaning you're going to outperform. In the past, you could just basically buy a ticker, like you said, top 500 stocks, or if it's technology stocks or QQQ, whatever it might be, and you're probably going to do pretty well, right? Mm-hmm. But those days, I think, are numbered. And it's going to be more about stock selection. This is where we add value. This is where, as advisors, people like us, money managers that go in and don't just follow a simplistic 60-40 balanced portfolio, we're going to shine. This is where we shine. This is where we earn our keep.
Yeah. What about, like, for someone who needs, like, $10,000 a month in retirement income, how do things like structured credit or private real estate help us build, like, a bulletproof income floor? So they don't have to sell stocks when the market's down.
I think that's the beauty of it, is having a focus on a portfolio that will lend itself useful for an income supplement, right? So if you have something that's kicking off a yield or dividends, whatever it might be, and that could be in the fashion of some good old-fashioned value type stocks. It could be some actual real estate. We have clients that own real estate. I'm not talking the investment, non-traded REITs and even publicly traded REITs,
I love
but
that.
owning a real asset, right?
I
It's
love
not for everyone.
Yeah. No. I agree. But somebody that can be diversified enough that they have their own personal real estate portfolio. Like, hey, I have, 5, 6, 7 rentals, this, that, like whatever the case may be. Own some commercial properties. When you have the ability to do that, I think that's the real game changer for you.
I do too. Those deals are harder and harder to find right now.
Absolutely.
Interest rates, I know, are okay. I don't think they're sky high, but it's going to be a problem when you purchase something from somebody. Let's say they bought it for $100,000 20 years ago, and now you're paying $500,000, and it generates a little more income than it did when they bought it. However, it doesn't cash flow, and that's the name of the game when you buy these properties, especially in our area. We're maybe a 2% growth rate, if you will, on real estate. You go in other markets like a Florida, and that fluctuates sometimes 15, 20%.
Sure.
So it's interesting. I think time will tell regarding how long the war is, the impact on oil prices and all the things that we spend money on, food and groceries. Any other closing thoughts?
Yeah, I would just say for people that have money on the sideline, like develop a strategy of, again, specifically if you don't need that money or don't foresee yourself needing that money in the next, 5, 10 years, develop a strategy with your financial advisor of how we get that money working for you. Let it sit in a money market earning 3, 3.25%, 3.5%, whatever your money market can get you, or high yield account. That's fine in the short term. Make sure that you're sitting down and you have a strategy to implement so that money long-term can be working at a higher rate of return. And especially in this market that's pulled back out of fear, out of a lot of uncertainty, this is also a premier buying opportunity. Take advantage of it.
Yeah, I think at the end of the day, the core message there is meet with your advisor, have a game plan, and take action.
Yes.
You follow those steps, you revisit, you analyze, you measure your success, and find out where your shortfalls are and correct and change those. Yeah. Once you implement that plan, the ongoing, and that's the thing too is, oh, geez, maybe I don't need a financial advisor to manage my money. You can come in. I could give all the answers today on the podcast, every single thing to buy and do. Now you have to go in and actually take action. Most people, I'd say 75+% will not do that. And that's why when we do this show and we give out this information, I have existing clients saying to me, geez, it seems like you're giving away the house. It's because of the process, right? It's the whole mentality of working out and exercising. They're going to give you a diet plan. They're going to hold you accountable. It's not the answers. We all know what to do. We all know to eat healthy and exercise, and we do just the opposite. We have the answers.
I like cake.
Well, I don't know what's going to do to your waistline, but
well, it's already big enough, but we'll get there. But I agree with you. I think that ultimately, like, oh, do we give away the farm on this show? And you give a lot of good tidbits. It's the execution of it. I can't tell you how many even people that I sit down with at times, give them a plan, and it seems to take them so long to get back to me with like, okay, like to proceed with these things because of life. Because life is busier than it's ever been. Most families have the husband, the wife, both spouses working, multiple kids in multiple sports, and like it's the craziest, most hectic, busiest time ever. And technology helps, but it also hinders because it allows us to be doing more things while we're doing more things. So to that point, I think when you get to a certain asset level, and that varies for everybody a little bit different, to have somebody that will execute this stuff on your behalf. They understand I'm paying a fee for this, but I know that everything is going to get done, and it's one less thing on my plate that I have to worry about actually doing. And there's value in that. And I think as you get older and you realize time on earth is finite, that I'd rather pay an advisory fee with somebody that I trust to execute all these things that we discuss. And it's one thing off of my plate. So when I have time, I'm focusing on the things that really matter. My spouse, my children, my grandkids, vacations, things that I love and have a passion for. Well, this stuff is all working behind the scenes with a financial advisor and a firm that I trust.
I think we could do a show just on that. Why do I pay an advisor?
Next show, let's do it.
All right. That sounds good. I think that's all the time we have for today's show. Thanks again for listening to the Pennywise Financial Podcast. We'll see you next time.
You've been listening to Pennywise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is Pennywise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC.